So have you ever panic sold something? The price goes down a lot and it scares you and it causes you to go out and sell. And it turns out that was the exact wrong time to do it. I think this happens to lots of people. It's happened to me many times in my life. And one of the things I've been trying to do is figure out a way to make that not happen to me anymore. Because what I feel like is if I were just to avoid the times where I wash out of the market when I shouldn't, when I should actually be buying instead of selling, when people are scared, but I'm scared too instead of being greedy, how can I identify those things with a metric or several metrics? How can I tether myself to reality? So let's look at this example right here. I've got Meta, its stock chart, which I don't look at very often over the last 1 month. And you can see it started off a month ago at 619. It's currently at 543. But in the meantime, there were some wild swings. So when people started panicking about the tariffs, remember, Meta doesn't even make anything that is shipped that would be subject to tariff, really. But we see it started at 583 in the week and it shot down to 504. It actually got worse than that if I look at a 5 day chart. It started the day on Monday morning of this week at $483.99, and that was only 5,000 shares. But look at this, at 4 million shares traded at $497 on Monday of this week. By Thursday or late Wednesday, it was at $585, $100 higher. And then it wildly gyrated more and more, as you can see, and ended the week at 543. These are wild gyrations, far in excess of anything that's normal. And why does it happen? Because people are scared. And I think this is a representation of emotional trading. Emotional trading is not profitable trading because it is subject to your emotion, which again, you get scared when people are scared, which is when prices are low. Because many people, most people, myself included until fairly recently, would use the stock price, whether you want to admit it or not, as a general barometer of the safety of your investment. When things go up, it feels safer. When things go down, it feels scarier and riskier. But those are the exact opposite ways we should feel. So I want to instead introduce you to a new way. And so in a nutshell, here's the different way. The different way is instead of getting your information, your primary informational content about the safety or relative unsafety of any of your investments from the stock price, you instead look at the company fundamentals. Duh, yeah, I mean, it sounds obvious, but it's hard to do. Like trying to find the company fundamentals in Yahoo Finance or in Google Finance is darn near impossible, and especially to make sense of it. Like if, let's say Meta made, I have no idea what they made, but let's just say they made $100 billion last year, just for a number's sake. What does that mean to you? If you invested $1,000, which is on the screen here, if you invested $1,000, what does that mean for you? What's your share of the profits? What are your share of the sales? What's your share of any dividends that are paid? And so this site answers that. So we're going to type in Meta and we're going to pull it up. Okay, so based on $1,000 investment, here's your share of the business. So when you're buying Meta, when you're paying $1,000 for shares in Meta, you would get that equates your share of Meta's revenue is $119.43. You put in 1,000, $119.43 of their stuff last 12 months revenue is yours. $45, a 4.5% earnings yield, is your share of Meta's income on a $1,000 investment. Their dividends is $3.68. Obviously, they're not paying a whole lot right now. Your share of their long-term debt, $20.93. So when you're buying $1,000 in Meta, what it is showing you is that you're buying a company that's indebted by $20.93. But they have cash that more than offsets it. You can see they have balance sheet cash 3186. This is really just a financing thing. So they're effectively debt free. You can also see what their operating cash flow is and other revenue metrics here. But this is what I really want to call your attention to. This is the chart of all the charts that I focus on the most, which is their earnings history over 10 years plus the TTM, which is trailing 12. You can see is this is up and to the right, quite literally. And in fact, it's a 34% compounded annual growth rate over the last 10 years. It started out 10, your share, if you bought $1,000 worth today, that same $1,000 worth in 2015, if you kind of went backwards in time, was only making $2.42. And now it's making 45 bucks. It's just skyrocketing up. Same thing with revenue. It's up and to the right. It's absolutely fantastic. You go from $11.76 or 77 cents in 2015 to now it's at $119. And you might notice these two are the same. It's because the trailing 12 months period, they haven't yet reported their first quarter, and so these two are the exact same number. you can look at all the other things too. Like, let's look at how fast they're growing. This is CAGR comparison, it's compound annual growth rate comparison. Their revenue over the last 10 years, the average annual growth rate is 34%. Net income, or that's net income, sorry. Revenue is, well, it's not showing me. I don't know why, but I'm eyeballing it here. 26% growth in cash, growth in operating cash flow. Debt is, and free cash flow, very, these metrics are not plugged in yet, I guess. And then we can look at dividends too. So it didn't start paying a dividend for a long time, but then it started paying one at $30.68 is your share for $1,000. That's what it's going to pay you, which is not very much right now. But let's look at the payout ratio. What we see is the payout ratio is the ratio of what it actually paid out relative to its net income. And what you can see is that it's only paying out 8.1% of its net income. Let's just say that it could sustainably pay out 80%, just for round numbers sake, my math, so it's easier in my head. It could pay out 10 times more than it does right now. You can see that right here, just from this information, we see net income is growing like crazy at a hockey stick pace. And ignore this last period. It's at a hockey stick pace, exponential curve. Revenue is also trekking up. Even during COVID, it actually didn't slow down. It sped up in terms of its rate of growth. It's paying dividends, but it's barely paying out any of the cash it actually needs. And so it has a payout ratio that's very low, which means that dividends could grow even faster than net income and will most likely. It has a tremendous cash paying potential. And so when we look at it this way, as price goes down, these numbers actually adjust so that the net income you're buying, one way you could look at this is you could say, for $1,000, I'm buying $45 of net income. And so if prices go down, this number will actually go up. Now, today I can buy $50 worth of Meta's net income. What a bargain that is. You see the paradigm shift where you go from looking at the price, and when things go down, the chart you look at looks terrible, to when the price goes down and you look at this chart, the net income chart, the amount of income that you can buy from Meta actually goes up. And so it makes you feel better. When this number goes up, you actually are in a safer position. And when this number goes down, you're in a less safe position. So this is a way that you can look at the relative, in a very quick way, the relative risk of your investment at any time. That's a far superior way relative to